Happy Friday to everybody. Good morning or afternoon, depending what the case may be. Now, we've already received a number of questions, and starting now, you can submit additional questions to our moderator, Melinda, by typing them into the Q&A pop-up at the bottom of your screen. Following some prepared slides, we will address as many questions as possible during the second half of our 30 minutes. And finally, just want to let everybody know we are recording this webinar, and we will share the link with all attendees next week. So let's begin. Now, there's a wide divide, obviously, between those who have serious concerns about a run-up in inflation and those who are more comfortable about where inflation is headed, including, so far, the Fed Chairman, Jay Powell. And the Fed's more relaxed attitude is rooted in their new monetary framework featuring this outcome-based approach rather than the earlier forecast-based approach. And this big shift in the Fed's reaction function followed the abrupt truncation of their last rate hike cycle in January of 2019, the so-called Powell pivot. Now, unfortunately, in our view, the Fed learned the entirely wrong lesson from that episode. And as a result, going forward, the risk of inflation has actually been heightened. Now, before we review the inflation debate, let's take a quick look at what a cyclical view of inflation can provide for decision makers. Here we have a slide showing over the last 5 years that ECRI has made 3 inflation cycle calls based on our future inflation gauge, or the FIG, we call it FIG. Now, this chart marks off the timing of those calls against 10-year Treasury yields. And clearly there is some helpful information here. The key is that the FIG is focused like a laser beam on the future direction of the inflation cycle. However, most inflation forecasts rely on model-based approaches using assumptions that are questionable. And so before we dive into ECRI's cyclical perspective, let's do a quick review of the evidence underlying the current debate about whether or not inflation will get out of hand. Now, a key part of the concern has been voiced by the likes of Larry Summers and Olivier Blanchard, and includes the idea that the output gap between the economy's actual and potential output will blow up. Now, in theory, that could be highly inflationary. The worry is that even though the output gap was still negative through the first quarter of 2021, the government's enormous spending is going to push actual output way above potential. Now, of course, if you look at the chart, you'll see that in 2018 and 2019, while actual output was well above so-called potential output, inflation subsided, and that's marked off by the red arrow. This may be why Summers recently said, look, economists don't know what drives this stuff. They're not sure. So this output gap framework is related to the concept of NAIRU, the non-accelerating inflation rate of unemployment. The theory being that if the unemployment rate falls below the NAIRU, inflation will ramp up. Until a couple of years ago, that was the primary basis of the Fed's inflation forecasting framework. So in 2018, when the jobless rate had fallen below the NAIRU, the Fed was raising rates, ostensibly as a preemptive move against inflation. But as the chart shows, in mid-2018, inflation actually turned down, again marked off by the red arrow. So this failure motivated the Fed's adoption of its new monetary framework, culminating in its subsequent declaration that it would let inflation run above target to make up for all the years it had been below target. So henceforth, it would only consider tightening policy after we'd seen inclusive growth across different demographics, and then inflation had risen quite noticeably. So we don't see why that should be the sequence of events. Now, lacking the tools to predict inflation, the Fed has effectively declared that inflation is not the more important part of its dual mandate. It intends to focus on achieving full employment, secure in its belief that there's been a structural change as a result of which the narrow is still relevant, but that going beyond full employment will lift inflation very low. And this is why the Fed thinks it can afford to pursue an outcome-based approach and doesn't need to forecast inflation, which it doesn't know how to do anyway. So stepping away from these models and looking at real-world historical experience, wouldn't the huge budget deficits be inflationary? And it's actually not that obvious from the data. Okay, the deficit as a percentage of GDP hasn't been this high since at least World War II. And while CPI inflation has rebounded from 0.25% last spring to 4.2% in its latest reading, and that's partly due to base effects, in itself, this is not yet concerning. The real question is, where does inflation go from here? During the Second World War, despite large deficits, inflation stayed in check, and that has much to do with wage price controls. But in the 21st century, to the right-hand side of the chart, even as the deficit as a share of GDP has trended up, inflation has been trending down for the most part, and that's marked off by the red arrows on the chart. Conceptually, one could argue that massive deficits need to be inflated away unless real economic growth actually sees a sustained pickup, as it did in the years following World War II. Yet the empirical evidence seen here, especially from the 21st century, doesn't seem to support this contention. But will the sheer size of the latest deficits force the issue? Now, the issue of deficits speaks to the size of fiscal stimulus and possible unintended consequences. But how about the unprecedented monetary stimulus that's going on? Milton Friedman famously said, inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. And so accordingly, this 100-year chart shows money supply as a percentage of GDP, and that percentage is at an all-time high. But again, looking at the empirical relationship, we see that in the 21st century, this percentage has been trending up quite strongly, yet inflation has been trending down for the most part. And that's again marked off on the chart. So Fed Chairman Jay Powell said as much last month, and I quote, that classic relationship between monetary aggregates and economic growth no longer holds. We've had big growth of monetary aggregates at various times without inflation. So something we have to unlearn, I guess. So at ECRI, we're not as convinced that monetary and fiscal stimulus are irrelevant to inflation. But in any case, it wouldn't hurt them to relearn, hurt the Fed to relearn that inflation is cyclical, something that they actually knew back in the 1990s. So turning to cycles, inflation cycles, what do we mean by inflation cycles? The thin line on this chart shows actual CPI inflation. And the thicker line segments, the zigzag segments, show upturns and downturns in the inflation cycle, meaning alternating periods of rising and falling inflation, with the latter, the falling inflation cycles, shaded in blue. So in fact, there are many more inflation cycles than business cycles. And that's evident from this chart showing the same inflation cycles along with gray bars indicating business cycle recessions. And as you can see, the vast majority of inflation cycle downturns occur away from recessions. They even occur in periods when actual output is above estimated potential, and the economy looks to be beyond full employment based on the narrative. So that was like in the 1990s, and also in 2018, which we marked off with the red arrow again. So these inflation cycle downturns demonstrate why the Phillips curve has been so misleading and why the Fed was forced to give up on that framework. So the problem has been that in recent years, the Fed has mistaken inflation cycle turns for structural shifts. In the summer of 2016, inflation's expectations had actually plunged near record lows, and 10-year Treasury yields were also at record lows. But based on the upturn in the future inflation gauge, the top line here, which is a composite index of leading indicators of the inflation cycle, that was when ECRI made an inflation cycle upturn call. And the Fed then embarked on a sustained series of rate hikes. By the middle of 2017, they'd become convinced that the economy had undergone a structural shift away from lowflation and low trend growth, meaning that they had succeeded in finally normalizing the economy. And this was the Fed's mindset going into 2018. Now, in February of 2018, the FIG turned down and CPI inflation followed suit after peaking in July. If you recall, that summer and well into the fall, bond market royalty was pounding the table about Treasury yields rising to 4, 5, even 6%. And the Fed kept hiking rates all the way through December of 2018. It was only in early January, 6 months after inflation had turned down decisively, all the way on the right-hand side of this chart, that the Powell pivot reversed the course of monetary policy. So this experience here made it hard to deny that their approach to inflation cycle forecasting didn't work. But again, that's because they didn't understand, the Fed didn't understand inflation cycles. And as a result, they have overhauled their entire monetary policy framework, making it now outcome-based. So I've given you a very different perspective on inflation forecasting than the standard narrative. Inflation is actually cyclical, and the FIG has a very good real-time track record. So with that in mind, what is the FIG saying today? For quite some time, it's been telling us that inflation is in a cyclical upturn. And as this chart shows, the FIG turned up more than a year ago, and inflation has followed suit. The continued cyclical upturn in the FIG tells us that the inflation cycle upturn is not about to end. And meanwhile, the Fed, believing that the Phillips curve is very flat, thinks it can run the economy hot for a long time in order to drive a lot of jobs growth, but with inflation staying in check. And that's why, in Powell's words, the Fed is not even thinking about thinking of tightening. But others are concerned that inflation can get out of hand as it did in the 1970s. And the Fed says that even if that were to happen, it has the tools to bring inflation back down, as late Fed Chairman Paul Volcker had demonstrated. But whether the modern Fed will have Mr. Volcker's intestinal fortitude to drive the economy deliberately into recession in the face of political opposition is an entirely other matter. So notably, the FIG signaled the current inflation cycle upturn well before inflation became a serious concern in the markets. And this makes sense because the concept of inflation cycles and leading indicators of inflation is relatively unfamiliar, not only to today's Fed, but also to the current generation of bond market professionals. Which brings us back to this chart that we kicked off with. Over the last 5 years, we've made these 3 inflation cycle calls based on the FIG. In the late summer of 2020, we called the inflation cycle upturn. Treasury yields were still at all-time lows. That's the right-hand red arrow. We've already just talked about the 2018 inflation cycle downturn call ahead of the downturn in yields. It's the arrow in the middle. And back in the summer of 16, when yields were near record lows, we made the upturn call based on the FIG, and that's the red up arrow on the left. Regardless of all this evidence, the dominant paradigm around inflation in academia, within the Fed, and on a lot of Wall Street is not going to change quickly. And that's unfortunate in many respects. But the good news is that the rest of us aren't really forced to play along. As this chart shows, monitoring the FIG in order to manage cyclical risk can be pretty profitable. And the big question many have today is whether the current rise in inflation is transitory or if we're going to see a much bigger run up like in the 70s. Now, if you know that inflation is cyclical, you actually don't have to buy in to either kind of extremes of those viewpoints. The FIG is agnostic, and it's focused like a laser beam on the future direction of the inflation cycle. Now some people also say, what's going to happen with inflation over the next few years? And here, our research shows that that may not even have been determined yet, let alone be knowable, because the economy is a highly complex system with nonlinear dynamics and extreme sensitivity to initial conditions. And so under the circumstances, those are the circumstances, we believe, based on all our research, that the best thing to do is to monitor the evolution of inflation cycle dynamics using leading indicators of the inflation cycle, the FIG. So that's all my prepared remarks, and now I'm going to turn to Q&A. Okay, so what is the FIG? Excellent. So my late mentor, Jeffrey Moore, he created the original index of leading economic indicators, and he created the future inflation gauge in the aftermath of the stagflation of the 1970s, which showed clearly to him and to us that the inflation cycle was quite different from the business cycle. And that's one of the slides we touched on earlier. So the FIG is a composite leading index of leading indicators of the inflation cycle. Its purpose, its design, is to anticipate cyclical peaks and troughs. And in other words, the primary focus, the key piece of information, is on the timing of those inflation cycle turning points. The FIG is proprietary. Our leading indexes are proprietary, but I can tell you that it includes measures ranging from like kind of early stage inputs to labor markets, to inputs related to money and credit. But the key is to recognize when or as different drivers of the inflation cycle are reinforcing one another. And that's really what the FIG does well. That's what our leading indexes are designed to do well. And so another question, how do you get the FIG? You have to get it from us, so just feel free to contact ECRI. You could reach out to Melinda at businesscycle.com or through the website or LinkedIn, and we can arrange for you to get access to the FIG. In essence, the next question, in essence, is the FIG measuring inflation expectations? And the short answer is no. The FIG actually anticipates cyclical swings in inflation expectations. And that's why you can use the FIG to manage inflation cycle risk. If you want more information on the FIG and inflation expectations, again, just reach out, Melinda at businesscycle.com, and we actually did a whole presentation on the FIG and inflation expectations, and so she can send you that presentation. What data are you watching to determine if inflation will be more than transitory? Okay. Well, as discussed, we watch the inflation cycle. We monitor the inflation cycle using the FIG, and that began rising more than a year ago. And so that's long before the transitory inflation narrative kind of took hold and came into focus. So that's one thing to note. Today, as we showed, we're in an inflation cycle upturn that began last spring, again, before any reasons for a transitory pop in inflation were in play. The fact that the FIG is still rising tells us that this is a sustained upswing in the inflation cycle. And, while we don't predict the predictors, we're monitoring the predictors. If, now I'm speculating, the FIG turns down in short order, inflation could peak soon. So it could appear to be transitory. But even in this instance, inflation would have risen for more than a year, which is hardly transitory. And, in that scenario, the Fed, it could appear to be right, but it would be for the wrong reasons. It would be a cyclical downturn in inflation. Now, this is binary. It could turn one way or the other. Alternatively, if the FIG keeps, or not turn, if the FIG keeps rising for a while, we can see an inflation scare down the road. And 1970s style inflation wouldn't be out of the question. And so, look, a lot of things are different over time, right? Things, structures and the landscape shift. So a good question is if the FIG is robust enough to deal with such an environment. And our answer is absolutely. It was, remember I mentioned earlier, it was originally designed in response to that stagflation of the 1970s. So that's the answer on transitory. Let me see here. Okay. If the FIG is so good, why haven't most people heard of it? Fair. Inflation cycles, they have not been a part of the way people think, actually, the paradigm in the 21st century. I've been doing this since 1990. I think it's a very practical and useful framework, but it is not a model. And economists whose environment is kind of, defined, permeated with models, find it pretty hard to think beyond them. It doesn't come naturally. And so it reminds me of what a well-known psychologist once said, that it takes a very intelligent and non-parochial fish to realize that its environment is wet. And so therefore, you might get a little stuck in your thinking potentially. That might be part of the answer. But to be clear, the Fig did, when I started off in 1990, there's a recession there that that we got pretty good, that others didn't see. But then what I got to see, firsthand was how the Fig did in the 1990s, and we have a very different view than probably most about what happened there. The Fig navigated inflation cycles very well. And it, I think, is reasonably well known that it was influencing Fed policy. So it was a very well known indicator circa 1990s. Later, fast forward a while, which is interesting to see an indicator just work real time over time. Later in the lead up to the Great Recession, the Fig did spectacularly well. In June of 2008, and you should go and check the tape. The Fig had dropped to a 4.5-year low. All right, so pretty clear, pretty clear downturn. Yet the Fed was hawkish. We'd had a stimulus and oil was up. The Fed was super hawkish, and so the markets were pricing in more than 100 basis points of rate hikes by the end of '08. Totally the other way. So that's a spectacular call. Now, next question here. We've got, does the Fig distinguish between supply or demand side of inflation? And is that even relevant? And here, yeah, that's a totally relevant question. And both sides are implicitly, they're taken into account in the Fig. But of course, the real key thing, again, going back to, what is it that we're doing? What's the insight? Is that the Fig subsumes underlying cyclical inflation pressures from all the key drivers of the inflation cycle. And that's what's really unique here in the performance. Now, we also had received some questions earlier in the week. So I got it. We managed to put together at least a couple of slides to help answer those questions. I want to just turn to them real quick, but we have a couple of minutes left here. Question was, how does ECRI watch global inflation cycles? Because so far we've just been talking about the U.S. and our whole international experience is quite detailed. But on this issue about inflation, we actually have future inflation gauges for over a dozen key economies, including China. And here is a composite of 11 of those future inflation gauges. Even though you can't see the individual ones, the reason it's moving that way is because they're all in cyclical upswings, which makes it more powerful. It's more pervasive. And then finally, I want to switch over here and give a glance at the Chinese future inflation gauge. You can see that is also in a clear upturn. And obviously that too has, implications for what's going on with inflation cycles, certainly globally, but even pressures into the US. So I think we're just bumping up on time here. And there's a lot of questions I've got here in Q&A. I know there's, how far out can the future inflation gauge look? This is cyclical, so it's looking out several months, but that lead is a little bit variable, but it's good that it's leading expectations, as we said earlier, and giving us a lot of conviction about the cyclical direction of inflation. There's a lot of questions here, and so what we're going to do, if we have your emails, or we will respond to you directly with those answers, and we will also maybe we could put some of the, if there's a lot of repeat questions, we'll try to put them in the deck that we send out to everybody. But I hope this was helpful. I hope this was informative for everyone, and maybe we'll do this again. But I wish you all to have a good weekend. And thank you very much for joining today.